This episode of Analysis in Chains is brought to you by our sponsor, Bankera. Bankera is building a digital bank for the blockchain era, and their token sale is on until the end of February. You can find out more when you visit them at www.bankera.com. And now for our show.
This is the Analysis in Chains with Nathan Williams and Neil Kieran.
Welcome everybody to Analysis in Chains. I'm Nathan. And with me today is Frank Saviane and Luca Mohammadi with JWC Ventures. JWC Ventures is a venture firm that connects people in the startup world with venture capital. They are working in Europe and in Southeast Asia, and they are just launching their new Blockchain Ventures Fund. Luca and Frank, thank you very much for joining me today.
Thank you.
Thank you for having us here.
So I want to talk a little bit about the state of venture capital as it is now, and take a look at how blockchain is going to be different from that. So, and I think that you guys would be well positioned to discuss this. So tell me, like, Frank, in a traditional venture capital deal flow, how would things operate for a startup trying to raise money?
Yes, so in traditional VC, one of the main problems is that, like Europe, like in Southeast Asia, is that you need to approach a venture capital firm that has a mandate in your country or in your region, and it's sometimes not very easy to find the right venture capital firm or investor that is actually having the scope of what you're looking for. This is true for Europe, where a lot of different countries within the European Union are operating. You can have investors from Germany that are investing in Europe, but they might have some restrictions. And the same applies for Southeast Asia. You can have investors in Singapore that want to invest in Vietnam or can invest in Vietnam. And but you need to understand if that's in their scope. So as advisors, we sometimes had problems in really identifying which investors have a scope of work in the countries where we are operating. And this becomes even more true if we look at the global space. So if you're an investor in Europe and want to invest in Southeast Asia, it becomes even more trickier. The second point is related to regulation. There is a lot of problems around regulation of VC funds, cross-border regulations, international law that is different between different countries and different regions, that makes cross-border investing and setting up funds that do cross-border investments make it really, really, really difficult. And this is where I see a huge potential in setting up something based on blockchain.
Luca, from your point of view, is Southeast Asia significantly different than Europe when doing a venture capital deal flow?
Surely there are some key differences. I would say that the Southeast Asia ecosystem is rather new compared with more mature environments like US and Europe. And by being new, it means that it's still not, let's say, so well organized, and capital is available, and venture capital in terms of total investment is increasing year by year in really impressive numbers. Just to give you an example, in 2017, total investment were about 7 billion, and the year before was around 3 billion. So it's growing a lot, but cross-border is even more an issue in Southeast Asia than Europe. Europe still has a sort of integration of local regulation, while in Southeast Asia that's not the case. It's very difficult for a fund that is coming from Philippines to understand the law in Vietnam, for example. So each country needs to rely on local investors, and this number is still, I would say, not sufficient. That's very important also, and is one of the key points that brought us to our new mission in setting up our own fund, because we identify a gap of very interesting companies that have challenges in looking for funding in Southeast Asia.
When you're talking about disorganization, or that it's not quite as organized as it is in perhaps Europe, what do you mean by that?
I mean, first of all, specialization. I think Frank also mentioned about this point. In Europe and US, we see many VC that are highly specialized in a specific industry, in a specific segment. So when we work with companies in the medical technology space or energy technology space, we really can find a reasonable amount of, let's say, investors that are interested in that specific segment. So that means that also they can provide really support for, apart from the funding itself, to the company to grow. They can understand what the company is doing. They can easily assess the opportunity. But here, that with some exception is still not the case. So we really find many cases where the company we believe is doing something interesting, but we have challenges in finding the investor that understand about that specific business model and understand the opportunity and is willing to invest.
So it's more about. Oh, sorry. Go ahead, Frank.
To add on what Luca said, I think it's also in terms of availability. There is just a lot of available capital right now in the US and in Europe because of let's say fixed income, flat interest rate period that we are living in. So money, cash is not the problem in low growth economies like in the Western world right now. That brings also the VCs to actively look for deal flow and really be keen to work on the deal flow. Second, the VC structures are more classical VC structures, which means that they also have pressure to invest and to find interesting deal flow, while in Southeast Asia there are a lot of industry investors, greenfield funds, private investors that just became very wealthy during the emerging markets growth, but don't have a structure to invest, don't have deal flow structure, don't have a fund structure where to nest that asset. So that puts additional uncertainty when actually looking for investments in Southeast Asia compared to Europe and in the US, where you can easily find investors advertising that they have a fund and advertising the investment strategy, and also pressuring for good companies to come because they have a mandate from their limited partners.
Now, I've been told by various people, you hear the rumors going around, that smart money is a myth, that investors that really get involved and can really help a company it's much more limited than what one might expect. So I wonder, does it really make a difference in Southeast Asia when they don't have as much structure to really understand the core vertical that they're investing in?
I believe the key problem of not understanding the industry is sometimes refraining from investing at the first place. So if they don't understand that specific industry and that business model, they won't invest. So I think there are very interesting opportunities on the market that are still, let's say, not managing to raise funds, and some investor that might offer not really good deals to entrepreneurs, because by not being able to understand deeply the business model or the opportunity, they will come up with, let's say, worse type of deals. They will see more risk than maybe what is actually there. So I think there are different components of, let's say, this lack of specialization. But on top of this, I think still a big problem is the complexity of doing investment cross border. So even if we do find specialized, let's say, fintech, for example, VC in Philippines, he won't invest in a Vietnamese company because he won't understand the market enough.
So is this why you're putting together the blockchain investment fund? It sounds like this might be part of the solution to the problem.
Yeah, that's exactly the case. I think before entering in Southeast Asia, we did not really feel a need of having our own investment fund because of the availability of capital in Europe. We could really tap into the right investors when we had an interesting project. But here we feel that many interesting projects are left there on the table. So we wanted to find a solution for this. And when, let's say, seeing what the blockchain and let's say the tokenization of in the venture capital space could offer, we really jump on board and start building this new project.
I'm wondering about the VCs in general, right? Because if they're nervous about investing in something like a well-established vertical that they might not understand, is blockchain one of those verticals? Like, have you felt that there's a bit of hesitancy towards going into a blockchain fund, or have they been excited by it and have a fear of missing out?
So blockchain in general, I think there is no doubt that VCs are approaching startups that somehow leverage blockchain to solve industry problems. When we talk about VCs that feel comfortable in investing in ICOs or token sales, that's a pretty different thing. I think there are very few VCs that are investing at ICO stage of a company. From one side, from a regulatory standpoint, it's challenging. As Frank said, let's say a venture capital fund is highly regulated, so investing into an ICO brings some challenging for them. On the other side, a lot of ICOs are companies that are selling a vision on paper, and that's is a sort of let's say red alarm for a traditional venture capital fund. So surely, I think there are a few names worldwide of VC that invest in ICOs. I mean, we can think about the Blockchain Capital in San Francisco, or let's say Fembushi Capital in China. There are cases where there are what we call, say, VC investing into ICO, but are very, very few.
I think that the investment in ICOs is adding some pressure to the normal, let's say, deal chain of deals of venture capital, like the accelerators and the incubators were putting pressure on VCs, like the whole crowdfunding and equity crowdfunding was putting pressure on VCs because they were investing, or it's an opportunity to invest very early. I think the whole blockchain and and the whole opportunity in investing in ICOs is adding to that pressure because not only institutional investors but also the crowd can actually invest at a very, very early stage and can potentially, and we have seen many different cases in Europe, in Asia, and in the US, raise money quickly and with very little lead time and very little overhead, raise money and bypass the venture capital space. So that is the risk on the VC side lately. That's where I see more and more pressure. And that's where I kind of connect to your vision, Nathan, that when you cannot bring expertise anymore as a VC because you're too much focused on finding deal flow and so on, money will be the same if it's coming via blockchain, via an ICO, if it's coming via Kickstarter.com, or if it's coming via an accelerator. The money will be money and will help you operate your company. And so I think in the future, VCs, traditional VCs, will be under a lot of pressure.
Well, it sounds like you're saying that traditional VC is actually old-fashioned and potentially vulnerable to being completely disrupted. Is that where you're going with this?
Yeah. Yes. So I think financial services and banking and is being disrupted with fintech. So I think blockchain is disrupting financial services on different levels and in different segments of it. Definitely, VC has been operating in a very traditional way. If you think about Europe, it's still regulated by very old investment laws where you need to have vehicles set up that need to be authorized by the national banks. So it's a very complex process, and the timelines, the lead times in setting up a fund and in investing and in keeping the risk down and making the right choices and the right investments for your LPs is maybe not the right approach anymore for a highly globalized, highly flexible, highly dynamic world where markets and products are changing in a much faster pace. So definitely, I think it's old-fashioned. Definitely, I think that a lot of VCs are already changing. There is plenty of examples of VCs starting to come up with new concepts on how to be faster, leaner in their investment process, in using digital tools, in using the internet, in using more cross-border friendly activities. But definitely, blockchain might revolutionize. And definitely, if someone is operating a very, let's say, VC with an old mindset, with a risk approach, with nested into a highly regulated environment, that will definitely be under pressure.
From my point of view, I've talked with a number of VCs. I've been in the startup world for a fairly long time. And I remember with my first funded startup, it was back during the dot-com boom. And, not everyone really knew how to structure a deal, how it worked. And this whole venture funding was so different than traditional, corporate investment into a joint venture or a new company because of the scalability. And you had to evaluate it differently and it seemed so brand new. And nowadays, when I talk to venture investors, the mode seems so old-fashioned, where you're taking equity and you give terms to the investors to protect yourself and that sort of thing. And then I look at the blockchain investments and people are just buying tokens and it moves lightning fast. And there's There's very little friction. The entrepreneurs give up, very little, but no one wants to miss out. And I don't know. I'm of two minds of it. On the one hand, I do see a big risk for traditional VCs of missing out on blockchain startups, which have the potential to disrupt the entire financial industry. And on the other hand, there's also the risk of investing in what amounts to a scam, or because there's not enough time to do due diligence, and there's not as much control that a company would have without having a stake. And I'm wondering, what your point of view of this on it is. Are we going to see more companies heading in that direction of saying, well, we don't want to miss out, we better invest in tokens, or are we going to see possibly people pulling back and saying, well, we can't just keep going into the Wild West like this and investing in something where we don't have control? What are your thoughts, maybe, Luca?
Definitely. I think now is ICO, they are unregulated by definition, and as I said before, many of them are really launching ideas just on a basis of a white paper. So it's a purely super early pre-product, pre-validation, pre-everything, and I believe that most of the VC would really stay out of that type of investment proposition. So, on the other hand, we witness already established companies entering the blockchain space and launching the ICOs, and that's probably what VCs are now looking into, and they are organizing themselves to be able to invest in that sort of opportunities. There was a case here in Southeast Asia of or let's say a payment gateway called OMIS that then entered the blockchain, and they issued the OMIS Go token, and that was a pretty successful activity, both on the, let's say, the fundraising part, and as well on the implementation of their new platform. And that type of project is something that is very suitable with the VC mindset, because there is already an history of the company, a validation on the market, a clear project plan that can, let's say, be achievable with less risk than just seeing something on the paper. So if we see VC entering into the ICO space, probably they will enter in that type of deals. On the other side, as you said, there are probably interesting companies that are really working on super early ICOs just with a white paper, but they can execute successfully. That type of deal would be out of the radar of a traditional VC. That would probably be a deal that a VC miss out, and that something that, on the other hand, we would, as a JWC, look into. So, what we'll want to achieve is to apply the, let's say, the VC deal flow analysis even to ICOs that are very early, but with the critical criteria traditionally coming from VCs, for really looking at everything and making sure that it's not just a scam. So the main problem of crypto investors investing into the ICOs nowadays is that they don't have this layer of analysis and verification. So they really need to believe in what they are being told, but they don't have an approach and a framework to evaluate these opportunities.
Well, that's a very interesting aspect, though. Like, how do you evaluate a white paper, or how can you tell what looks like it's going to be a scam and what is a legitimate project that's going to have the ability to execute? Because right now it's we've had in the past couple of weeks a number of very high-profile scams that have really rocked the market, and even some very valuable tokens like Tether are now under scrutiny for being potentially scams. So what sort of criteria do you look for?
So when we apply our own frameworks, we will look first of all at the let's see what we call the problem that is being solved. So we want to make sure that there is a problem worth being solved. That means that there is a pain or a need in the market, and that the second point is that the solution they're proposing is really a clear solution to this problem. And if we look at just at these 2 points and we apply this concept to ICOs on the market, already we can get rid of probably 30-40% of them, because we feel that a lot of these companies are really trying to force the application of a token just for the sake of launching an ICO. So if the token is not really needed in a specific, let's say, problem resolution, probably they are just, let's say, riding and hype. So this is a very important point. The second key point I would say is the team who is behind the project, whether they just put up a team for the first time, or there were people working together maybe on other project. As I mentioned before, maybe it's an existing company, let's say, launching a new solution based on the blockchain, or the existing team launching a new solution, a new industry. That for sure, even when we assess investment opportunity in a traditional way with equity financing, when it's the early stage, they look a lot into the team, whether they are working together for a while, they know each other, whether they understand the industry. So coming from the industry is very important. All these elements need to be reviewed and verified. Out of that, surely we look into the, let's say, the core product that they want to build, and whether that's really feasible, and how much risk there is embedded into that type of plan. Again, there are many ICOs in the market where they have super huge plans of domination, but they start from nothing. So we have to be very careful when assessing company that really state that they can be disruptor or dominator of worldwide industries in 2 or 3 years. That's never the case. So it is a mix of these elements, and I'm not saying that we get rid of 100% of the risk, but I think we can eliminate what is explicitly, let's say, a company trying to ride a hype or trying to scam. So this is a framework that, of course, we will start adapting. We will keep on improving time by time.
If I can add on that, the JWC has a pre-deal flow pipeline already, and it's 95% companies that already have been active on the markets and already have some track record. They already have been, they have customers, they have early products, they have some validation on the market. So definitely one of the ways is to use JWC Blockchain Ventures to invest in ICOs where we see some potential, but also use this hybrid of kind of VC mindset and validation analysis with the dynamic aspect of investing in ICOs. And one of the key advantages, again, from our side, so our investors, the investors in JWC Blockchain Ventures, they also have an easy way to invest in us and to have a very transparent way of seeing what the deal flow is. In addition, the VC will be, and I forgot to mention that at the very beginning, this VC is going to be liquid. So we will try, and we already are in discussions with different exchanges, but we will try to get into an exchange so that the VC actually becomes liquid. So that's also a very new aspect of VC investing. While VC investing usually has a horizon of 8 to 12 years from the deal flow time, investment time to the disinvestment time. With a blockchain based kind of venture capital firm, you can get out and in from the venture capital via the exchanges, and we think that this will create some challenges in understanding how to actually value the tokens and so on, but it will be a huge opportunity for more and more investors to get into venture capital, because they can just develop a portfolio, create value, and then if they don't want anymore, get out, which in traditional venture capital, again, is not possible. Once you're linked to a venture capital firm, you need to leave your money there for 10, 12 years.
That's a really interesting point that I think I hadn't even considered before, which is just how liquid venture capital can become. And I don't know, I guess just thinking out loud here, that could really change a lot about the industry, including valuations of startups, right? Because if you're thinking about it, right now, the valuation of a startup is based on certain traction, milestones being reached, team, speculation on future value, size of market, ability to capture and become a market leader. And subsequent rounds of financing are generally based on success in previous rounds and sort of hope and people backing the startup. Now, when you get into blockchain-based token startups, what happens to the valuation if the VC decides to sell? Right? That can send a very interesting signal to the market, and I wonder if it's hard to predict, because it could be that the VC decides to sell off some of their tokens if they're insiders and they see that, or if they get nervous about the investment itself and don't want to hold it for 10 years, or it could be the opposite, that they sell some of the good tokens, or the tokens that are doing well, because they've had other poor investments and need liquidity. And so I'm wondering if that would change how startups have to interact with VCs in general going forward. What do you guys think?
I would say that for sure we will see a sort of phenomenon where the valuation might not be that important anymore. I mean, the valuation as we know it, the enterprise value, because the company success will be measured on their token price, and that, let's say, the token price might not be directly correlated with the valuation. So if the VC invests into the let's say the company through the token, so through ICO or buying the ICO later on exchanges, and later down the road the VC decide to sell, that's might signal, as you said, to the market that the VC is not believing in the company anymore, or it might depend really on the situation. That could be that the VC is closing down even let's say tokenized venture capital could be let's say an ended type of fund. So after 10 years, they have to sell out all of their token, all of their position. So that's just a traditional life cycle of the fund. But I think we will see a very interesting new situation where a company will be measured against their price of their token, and in that say scenario, company might be willing maybe to buy back tokens from VCs when VC decide to sell.
To add on that, I think the whole hybridization of this market could introduce a whole set of new ways to see entrepreneurial finance and then to live entrepreneurial finance that might also be completely outside of our perception right now. So, for example, adding in valuations like market valuations, meaning how the stock markets work. So if all the VCs get listed and start investing into tokens, there is a market dynamic that would give a much, let's say, better proxy of the value of a company compared to institutional investor playing out what the value of a company is. So that would democratize and also improve the actual valuation, and also having a liquid market in VC would make the whole VC market much more dynamic and would put much more pressure into funds to actually invest and develop value of companies on a consistent basis, which right now is a little bit of a problem in traditional VC, because when a VC invests, they want to create profit, but the profit comes with a big sale to big institutional investors, corporations, or the public markets. So in order to do that, you need to prepare a company for 5, 6, 7, 10 years in order to get to that maturity and then sell to the market. So what happens between that early investment for a couple of millions of valuation to when you do an IPO where you are worth billions, you actually don't know. And that is the kind of disconnect that I think can be really and fundamentally disrupted by this liquid VCs. So having them connected to exchange would enable investors to come out and in to the VC fund, and that would create pressure into the VC to actually add value on a consistent basis and to show exactly what the company is doing, and to inform the market and the investors that actually the companies are doing well. And I think that will put pressure on VCs, put pressure on the competition between VCs. So to reconnect to what you were saying, I think there will be some fear of missing out, and this will create a whole spin of opportunities and dynamics in the market.
It'll be interesting to see how it plays out. The future is going to be exciting, and I can't wait to see how what's going to happen. Frank Saviane and Luca Mohammadi, thank you very much for joining me. Frank and Luca are general partners at JWC Blockchain Ventures. They are currently doing their token sale for raising their blockchain investment fund, and you can find out more at ico.jwcventures.com, and we'll put that link in the episode notes. Thank you for joining me, guys.
Thank you very much, Nathan.
Thank you, Nathan, for having us today.
Thank you.